Joining me with her analysis of what's played out on the market scene at midday is Cremen from AdviceWorx. Caroline, thank you so much for your time today. It's been such a busy week. Earnings, a sell-off in tech, Bitcoin and commodities also caught up in that sell-off. And then we also had a partial U.S. government shutdown. While the latter didn't last too long, it did affect economic data, and now the U.S. non-farm payrolls will only be released next week. We did, however, get some other official data that pertains to the jobs market. In particular, we got the private sector jobs numbers surprising to the downside. Perhaps let's start there. What do the numbers that we've gotten so far, what kind of picture do they paint with regards to the labor market in the States?
Well, probably a relatively incomplete picture because these things can actually be quite seasonal. So there were a few more job losses than expected, but a lot of that seems to be able to be blamed on bad weather. So that might affect it. So it would have been nice to have some clarity from the jobs numbers that would have come out today, but we're not going to get that. So what it has allowed is it has allowed the speculators in, and because of these weaker jobs numbers, people are starting to, some people are starting to say, well, the March rate cut is baked in because of these weaker numbers.
Yeah.
So we'll have to wait and see if that happens.
I mean, that's such a turnaround because many expected that we won't see any rate cuts until we get the new Fed chair.
And like I said, it's speculation. So,
Yeah.
and I think I think just if you have a look at February, I mean, I think everyone expected 2026 to be a little bit calmer, and then January kind of threw us out of our comfort zone, and then now I've realized in February that January was just a warm up.
January really was just a warm-up because looking at what has happened over the first week of trade for February, it's crazy. It really is crazy. The first week of Feb also kicked off a really big earnings week. We got some crucial big tech numbers out. Focus on Amazon and Alphabet's fourth quarter earnings. Numbers topped expectations, but investors still seem to be concerned about those big AI spending bills. Your thoughts around those numbers? Are those concerns over-exaggerated? I mean, these companies have said that they're going to spend tons of money, billions on billions, to make sure they stay ahead when it comes to that AI boom.
I think there's two things happening here. So the one, the sector has, I mean, the Magnificent Seven or top 5 you want to look at, they've run a lot over the last 2 years. So people are looking at these things and saying, look, are they overvalued? You start to see news organizations not pointing fingers, start to talk about AI bubble. So people are already very nervous.
Yeah.
Coming into that, I think people are finally starting to realize what I think investment professionals have hopefully realized for quite a long period, is that all of these companies are in transition. And they're in transition because they used to be very capital light. All the cash flow just goes directly to the bottom line because you're dealing with intellectual property, into things that are actually now quite, operationally heavy. You're building data centers, they're physical centers. So these companies, and people are finally looking at those numbers, and it's not that they haven't been in the numbers before, where people are saying that they're spending money. They've been there, but I think combined with this overvaluation and this AI bubble, people are now looking at that and saying, oh gosh, these are not just, the cash flow doesn't just go through to revenue and research anymore. It's got to go through to maintaining buildings and data centers. And people are panicking a little bit about it because you're realizing this is not the same Amazon as 5 years ago. It's not the same Microsoft as 5 years ago. It's different companies.
Yeah, so we're seeing new companies, not necessarily new companies, but they're in a new phase of growth as, that AI boom ensues and they try to take advantage of that and lead among the pack. I want to get your sense around the risk-off mood we've been seeing over the past week or so. Is it exaggerated, Caroline? There's been a sell-off across most asset classes, Bitcoin also tumbling, currencies under pressure. Today we did see a bit of relief, but the rand still above 16 to the dollar.
So I think it's a confluence of three kind of major issues that were there. I mean, the first one was the weakness in the dollar, which has been ongoing, and then probably thought that maybe this year the dollar will actually strengthen a bit. So there's
Okay.
been questions about that. Then there was the AI bubble, So and then coming with the AI bubble was a lot of speculation in the precious metals markets, especially the silver market, and then gold followed on after that. So I think you've seen a lot of speculative kind of in Bitcoin as well. A lot of speculative investments start to unwind, and then it's had a knock-on effect. Then it's kind of created again issues around the air. So it's just been like a little knock-on effect of panic generally. Whether I think probably the Bitcoin is probably completely justified. I think we saw today, I think it was Michael Burry actually, they valued it at zero,
Oh my
which
goodness.
I tend to agree with. For a number of reasons. I mean, it's not a store of value. It is
Yes.
completely correlated to the market. So what are you holding it for? I'm sure I'm going to get lots of notes about that back. But, as all of those things came together in one perfect week, and then you've got a government shutdown as well, people are just, okay, well, let's just take a bit of money off the table. And probably next week we'll turn around and we'll chase the rate cut that is coming in March.
Exactly. Hopefully, when we get those numbers, the jobs numbers coming through, there'll be some more certainty in markets. Before we move over to the stock picks, I want to get your sense around that Glencore Rio Tinto deal that's fallen through. Companies ditching a merger that would have created the world's biggest mine. Markets not too pleased about it. I saw Glencore down 3%.
So I must be honest, it was a deal that I didn't really think was going to go through.
Okay.
That you're dealing with a very contentious sector. There is a lot of regulation. There's a lot of government interference. So I always thought if one part of the world actually approves this deal, the other part is not going to do that. It's very, very difficult to merge these big miners these days. And I would probably say, if you're going to have a big merger, those are a thing of the past.
Yeah.
So it doesn't surprise me. It's unfortunate for Glencore, because Glencore kind of does want to remake itself as copper. It's kind of got to offload the rest of those coal assets and the trading assets. So it's like where to from here for Glencore. And it'll be interesting to see what comes out in the weeks ahead, because I think that was clearly part of their strategy. So now where are they going to move going forward?
And that's exactly what is rattling investors at the moment. Caroline, let's hit pause on the conversation before we move on to your stock pick. Let's reflect on counters that have found favor with your industry peers.
Renet. Renet's trading around 540. It's got about 570, 580 in cash once this deal with Pension Corp closes. The total NAV discount is probably about 25%, and they've said that they will resolve what they're going to do with the company in the first quarter, which we are halfway through now. And my judgment is that this company will be wound up and delisted.
I'm buying We Buy Cars. So last month, towards the end of last month, we saw the founders selling quite a large stake of their holdings. And I think that the market is unnecessarily worried about this. I mean, they have said that it is to diversify their portfolio, and maybe with the rand being as strong versus other currencies what it is, they want to maybe externalize some of their money. I think that at the current share price, it shows value. We think that earnings can grow in the high teens, and you get a 2% dividend yield. There is some temporary slowdown in earnings because of the cheaper Chinese vehicles which are coming into South Africa, putting a bit of pressure on the second-hand car prices. But ultimately, more cars in the car park means more business for We Buy Cars.
We Buy Cars and Reinet, your analysis of those counters.
Yeah, not too wild about either of them. I mean, I see the business case for We Buy Cars, but I mean, there have been very valid question marks raised around We Buy Cars and the way they look at the quality of the cars and the way these things are presented to customers. So I think that's not going to go away. I think they will weather the storm, but certainly not my favorite pick. The Reinet is a difficult one because, I would like to know what Reinet's strategy is. Right? And I think the thing most people do right now, almost feel it as like a little bit of a cash shell for the Rupert families. So, if I invest in something, I want to know what they're going to do with the money and where they're going. And right now, it's just a nice big cash shell or something that they're trying to offload. So, what are they planning to do with the company? Can somebody explain to me? If you can't, I can. In the past, when South Africans struggled to get access to offshore investments, it was maybe a nice thing to look at. But now you've got to come up with a business strategy that is understandable.
All right, let's get
And
in. They don't have one at the moment. Let's get into your pick then. Where are you seeing value at the moment, Caroline?
Well, I'm going to use the tech sell-off, should I say, to actually get into something which has sold off quite dramatically this year, and that's Microsoft. Because Microsoft's been very expensive for a while. I think year to date, it's sold off. I think it's sold off about 20%, just under 20%, and then this last week it sold off 7.45%. Came up with very, very nice numbers. Microsoft is not going away. Its dominance of cloud and its AI tools is not going away, and its PE is only 23, which is actually I don't think it's too expensive for such a massive tech company with such a lot of intellectual and other capital behind it. So it's something really, in my opinion, everybody should have on their portfolio. Very difficult to acquire, and when you see those opportunities, now is the time to start to accumulate them if you don't have them.
So buying the dip for Caroline. Caroline, thank you so much for your time and taking us through trade at midday. That was Caroline Cremen from AdviceWorx.